Good afternoon and welcome. As you know by now, Unlock the Stock is designed for retail investors to gain access to corporate management and to get to know them and their companies a little better. This episode is sponsored by Easy Equities, the platform that helps you grow and protect your wealth, where you can invest in local and international shares, property, unit trusts, cryptos, bonds, and actively managed ETFs. Plus, you get access to Easy Protect life insurance and easy credit lending to back your financial journey. We are very pleased to welcome to Unlock the Stock for the first time, Greencoat Renewables Plc. They have a fascinating story and investment opportunity to share with us. We are joined today by Paul O'Donnell, a partner at Schroders Greencoat LLP, which is the manager for Greencoat Renewables. He will take you through a presentation shortly. Johannes Heeman of Value Capital, who unfortunately can't be on the call today, is the sole corporate advisor to Greencoat and is bringing it to the JSE. Unlock the Stock is only possible with our technology partner, Lumi Global. Please visit their website at lumiglobal.com to learn more about their various online AGM and investor presentation solutions. Our host today, as usual, will be the finance ghost and Mark Tobin of Coffee Microcaps, who will lead the Q&A session. Before we start, there are just a few housekeeping notes. Paul will take you through a presentation, which will be followed by a Q&A session. You can post your questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on our Unlock the Stock YouTube channel soon, together with about 40 other videos that you can take a look at. You will see an email address, greencoat@valuecapital.co.za, when we begin the Q&A session. If you would like to be added to Greencoat's distribution list or have any questions about the upcoming listing, please reach out to Value Capital. Before I hand over to Paul, Jonathan, can you share the short video with us, please?
Greencoat Renewables is a leading listed owner and operator of European renewable energy infrastructure assets with a market capitalisation of €850 million. Our portfolio is well diversified across 5 European jurisdictions and includes wind farms, solar farms and battery storage assets. Our total capacity amounts to 1.5 gigawatts. We benefit from deep sector expertise and a strong leadership team. Greencoat Renewables has a progressive dividend policy with a current euro yield of 9%. Average dividend cover through to 2029 sits at 1.9 times. Our financial strategy and progressive dividend policy is underpinned by government-backed contracted revenues, which provide secure and predictable cash flows. The company is well positioned to play a leading role in Europe's accelerating energy transition and to capitalise on a sector expected to grow to €1.3 trillion by 2030. Through our expertise, innovation and scale, Greencoat Renewables is providing clean power for an electrified future.
Paul, we are ready for you to take us through some of your presentation, please. If you can share your screen, I'll tell you when it's up and when we can see it.
Hopefully, Vanessa, that works okay. Can you see it okay?
It's perfect. Thank you, Paul.
Thank you very much, Vanessa, and to all the team for giving us the chance to speak to your members and your listenership this morning. It's great as an Irishman to be coming down to South Africa and I guess continuing the increasingly strong partnership and relationship between South Africa and Ireland that we've had in recent years on and off the field. So I think to be the first Irish company to list on the JSE this June is going to be a very big milestone for us, and hopefully the sign of things that more to come between Ireland and South Africa, both in rugby and in business. I guess just turning to our own business, Greencoat Renewables, what I'd like to do is just to spend the next 10 or 15 minutes really taking you through the investor story that we've had, the journey we've been on, and why really we see Johannesburg and South Africa is a really strong opportunity for us to bring the story down to the Southern Hemisphere and down to South Africa. I think as we touched upon in the presentation, we've built Greencoat Renewables. It's a relatively young business. It actually listed in Ireland in 2017. It started life with 2 assets actually in Ireland. And today you can see it's built a very big portfolio, over 2.5 billion of assets, operating across 5 different countries. We really have started and grown the business initially into Ireland, where we're the leading owner of operator of renewable assets there. And then in recent years, we've expanded into other European countries such as Sweden, Germany, France, Spain. And in addition to that, we've started to diversify the technology mix as well. So starting to add technologies such as offshore wind, battery storage and solar. So we provide that sort of more diversified opportunity to get exposure both to different European markets and different European energy technologies. But what underpins the story that we have today is ultimately a set of assets that benefit from long-term contracted cash flows, and that then allows us to pay investors a stable dividend that has grown each year, and that also at the same time allows us to grow the value of the business year on year from reinvested capital. So what is our vision? We want to basically accelerate net zero transition, and we basically want to allow that to happen by being one of the largest owners and operators of renewable energy assets in the European market. And we've done that, and we do that by essentially having a high degree of cash generation in the assets that we own, which provide inflation protected cash flows. And again, a theme I'll touch on through the presentation, which is stable dividend and a lot of cash to reinvest in the business. What allows us to be best in class? We operate under the umbrella of Greencoat Capital, or what is now part of the Schroders business of Schroders Capital. And we are one of the largest managers of renewable energy in the world. We manage over 7 gigawatts of assets, and we manage over 400 renewable assets for different vehicles that we manage. So this is what we do. We know how to manage and operate renewable assets on a day-to-day basis and make sure we can drive the value in them. So what has the story been of Greencoat, I guess, over the last 8 years? So the first piece is in those 8 years since IPO, we've expanded into 40 assets and over 5 countries. We are a top 10 player in the European renewable markets and really a pure play renewable infrastructure company. One of the, I guess, bedrocks of our story is the cumulative dividends. So we've paid over 360 million or almost 370 million of dividends since IPO. And really what that has been is a dividend that started at 6 cents per share and that has escalated every year since IPO for shareholders. So providing that progressive dividend policy. The business is very highly cash generative. We've had an average of 2.2 times dividend cover. And that's then allowed us to, in addition to generate over 380 million of cash to reinvest back into the business and continue to be able to have a growing strategy. And we've delivered returns of about 8.6% on NAV since IPO. We touch right now, capital allocation is a key part of the market. So how do we think about allocating capital day to day? And in our market, dividend is sacrosanct. We had over, and last year we had 75 million by dividend paid. And then we decided to do a share buyback as well of 25 million. So over 100 million distributed back to shareholders. Our dividend for 2025 has grown to 6.8 cents. We continue to deliver transactions where we can kind of recycle our book, and that's something I'll touch upon in terms of selling assets to create flexibility in our gearing. And then finally, look, the market we operate in today is actually quite a mature market already in Europe in terms of the European energy transition market. Europe has really taken quite a policy process to essentially deregulate to force the decarbonisation of the electricity sector to happen. In Ireland, it's accelerating already, where we have over 50% of our power today coming from green electrons. And I guess over the last 12 to 18 months, we've seen how AI and growing demand is essentially going to drive the demand for electricity in Europe significantly over the next 5 to 10 years. What sets us aside as a business? I mean, I've touched a little bit on this, but we've obviously built a leading operator in terms of the scale of our business today. And we have the track record. I'll touch upon this in a second in terms of leading cash generation, dividend cover. Our cash flows are very, very predictable and inflation protected. We benefit from a high contracted revenue mix because of the contracts that we own. And we have the flexibility in our business model to fund reinvestment, all of which is underpinned by the fact that we value our assets today on a discounted cash flow basis to deliver about a 9.5% discount, equity discount rate. And I think that's an important point for investors to understand. You know, the business is, in terms of what is in the business itself, it is a DCF of our discounted cash flow approach of a portfolio of 40 assets. And the way the valuation is derived is essentially to forecast the contracted cash flows of the business over the life of the assets, and then those are discounted back to deliver about a 9.4% levered discount rate against the portfolio. I think what you see on this slide, I guess, is the journey the business has been on and sort of what has underpinned our performance since IPO. And you see a chart here that talks about the gross cash generation, so over 820 million of cash generated, you know, by the portfolio. We've used that over the period to pay over 360 million of dividends, and then the rest of the cash has either been used to repay some project finance debt or instead to grow our business. And we fundamentally believe growth is a big part of the business in the future, and being able to reinvest capital to grow our assets year on year, and in addition to that, to offset the fact that these assets do depreciate over time. When you look across the last 8 years, you see an average dividend cover at 2.2 times. You can see the slightly higher numbers in 22 and 23. That was connected perhaps to where we saw the Ukraine crisis happen and those sort of materially higher power prices across Europe. And we've stabilized today back to kind of a 2.2 to 2x to 2.5x dividend cover. How has the business performed? How should you think about the performance of the business over the last number of years? And what you see, firstly, is on the right-hand side has been the total return we've delivered against NAV since IPO, and then the blue chart represents the share price, TSR. So what we've seen is the returns are delivered in two ways. The first is through dividends, and the second is to grow the NAV year on year. And we've successfully done that since IPO, you know, delivering investors over 60% in returns in the last sort of 8 years or so. However, the sector today is suffering from on a listed side, there is a gap between the net asset value and the share price, and the overall sector trades at about a 30% discount to NAV. There's many reasons why there's a gap between NAV and share price. That the major reason being there's less liquidity perhaps in the UK market today, where a lot of the shareholders are based. And in addition to that, we've seen interest rate rises in the UK going to where yields are between 5 and 6%. So a lot of capital has come out of the sort of multi-asset sector space, and that's created a scenario where there's been a gap between share price and dividend over the last number of years. And I guess that therefore provides quite an interesting entry point for investors who see the story and can be attracted by the kind of the entry point that represents. What have we been doing with the business, and how has the business developed? Well, actually, the last 12 months has really been about demonstrating to investors in this part of the cycle that we have the ability to sell assets, and that we can sell assets at a premium to the holding value, to a premium to our NAV that we hold them at. So really, we've executed 4 different transactions in the last 12 months. The first, which was an acquisition, was of a new solar park in Ireland. It's sort of representative of the type of deals that we now see, which were benefits from a 15-year PPA with Microsoft. So that gives us a fixed price that inflates each year, and we have no kind of shape risk around what that price will be. As long as the assets generate, we then get paid that fixed price. We, in addition to that, agreed to acquire a project in Spain, which was a large wind park in Spain called Andella, that came into our portfolio recently. And basically, as part of that, we decided to sell down a piece of that to some of our private capital partners. And this really gives us exposure to the Spanish market, which is one of the more interesting merchant markets today. And the reason for that is that we are able to sell power at a quite low cost, and that makes it quite attractive for corporate PPAs. In recent months, we had 2 disposals that we executed, as you touched upon. One was at a 6% premium to our NAV, and one was at a 4% premium to NAV. In the case of the Finnish deal, Kokkoneva asset, we decided to sell that project to a local utility because we felt the price that the PPA price and the PPA contract didn't suit the risk profile that we wanted to hold in our portfolio going forward. And on our Irish asset, which was 116 megawatts in size, again, these were older assets that provided an opportunity for an incoming investor to basically look at a repowering scenario. So they were willing to put a higher valuation on the assets and we held them at, and we were happy to have some capital reallocation and to recycle our capital in these cases. I think that's a big part of a business like ours today, having been 8 years listed and having only grown really for the first 6 to 7 years of that. You know, the last 18 months have been about rebalancing the portfolio and bringing gearing back to around the 50% level. So what does the future hold for a business like ours, and how do we think about the future? Well, we benefit from the fact that we have very, very highly contracted cash flows. Over 70% of our cash flows are contracted out to the end of 2029. And then we continue to have long-term contracts beyond that. And what that really means is we have visibility today, a strong visibility as to what our cash flows are going to be for the next 5 years. And what you see on the chart on the right is, assuming our dividends continue to grow, you know, we continue to have the ability to generate really, really high dividend cover. You know, so in the order of 1.9x dividend cover over the next 5 years. And what that gives us the conviction of is that we continue to have secure cash flows which support dividend growth while giving us the flexibility to both reinvest into the business and grow our underlying portfolio. There is some sensitivity to merchant prices in there, and those prices are would see either higher or lower dividend cover depending on where the weighted average capture price is. But that's something that we think, in terms of the visibility we show people on that captured merchant price, we see those as quite conservative numbers against where European power prices are today. Maybe turning to our balance sheet and sort of giving investors a sense as to how we have approached gearing. So our business is primarily funded through holdco finance. So we have used a series of holdco finance structures at a topco level. And that gives the business a lot of flexibility in terms of how it wants to reinvest capital and how it wants to create value in terms of unlocking PPA strategies. We have about 1.3 billion of debt in the business today, so that represents 51% of gearing. And our average cost of gearing is 2.9%. And you can see that the 10 lenders that are with us, big global institutions and insurance companies, so you know, very, very strong support from blue chip investment banks. Our banking syndicate is very supportive. We recently refinanced about 225 million of our 2025 facility. And then we have a series of tranches that we then will refinance over time. The next one, which is due in 2027, and then further debt in 2028 and 2029. The key for our business is to remain and keep the portfolio highly contracted, which is the case. And we have the ability to do that by consistently signing new PPAs for our assets, as well as acquiring new assets from our excess cash flow. So maybe turning to the market outlook today and how we see the opportunity in Europe. You know, Europe really is experiencing a surge in power demand. And, you know, we've seen, I guess, as the AI revolution in particular has emerged, you know, we are seeing the demand for electricity being absolutely fundamental to unlocking growth. And in addition to that, we are seeing essentially the access to low carbon and low cost renewable energy has been fundamentally a source of competitive success in each of the European markets. And we continue to see opportunities in Europe today. The returns that one can achieve on assets have significantly increased as a result of the higher interest rate environment that we see in Europe. And in addition to that, given the amount of capital that is going to be needed to fund energy transition in Europe, that is creating opportunities to secure better returns, as there is less capital today chasing the sort of level of opportunities that are in the market. So bringing that together into numbers, we're projecting, these are some numbers where we project today the demand is going to grow from about 2.5 terawatt hours through to over 3,500 terawatt hours. And a lot of that growth is really going to be underpinned by increase in electric heating, increase in electrification of industries, the growth in data centers, electric vehicles, and as the pricing stabilizes for green hydrogen, there'll be a certain level of green hydrogen emerge. It's creating a €4 trillion investment over the next 30 years to come, and the bulk of that will be in proven technologies that we all understand, which is solar, onshore wind, offshore wind, and battery. A lot of this is underpinned not just by essentially government support, but also by the corporates that operate today. And we pick a quote there recently, from Google, where the demand for AI industry will go from 3% to 99%. So the tech sector themselves are seeing that for them to essentially deliver the AI part of the revolution that's coming, they need substantial investment to sit alongside that in renewable energies to allow them to power their data center sectors that are coming to Europe. We've probably touched a little bit on this in terms of data centers. In Ireland, it's actually particularly relevant because we already in Ireland today have about 25% of our electricity being used in the data center sector. That's creating a lot of discussion today about how big a role you want that type of sector to have versus other needs for power, such as housing, such as infrastructure, such as other assets which have a demand for power. So, what we see in Ireland, however, is the blueprint for how the data center sector will operate alongside the energy sector. And that is that the sector will need to provide a lot more resilience and backbone to the grid, and will need to play a much more active role to support the grid infrastructure investments that are going to be needed across to allow energy transition to happen in a more meaningful way. Again, I probably touched a little bit on this already. These are the key technologies. So we don't anticipate any sort of major change happening in Europe in the next 20 years. We think it will continue to be onshore wind, offshore wind, solar, storage, and hydrogen. There is still a big role to be played by gas. Gas will be the transitional fuel in Europe over the next 10 to 15 years. Coal is increasingly being phased out. We see that happening almost in every key market in Western Europe and Eastern Europe. That's now starting to happen as well. And I guess then the unspoken technology in that is then nuclear. And we are very much open to nuclear. We think nuclear plays an important part in energy transition. But the challenge in Europe is the time it will take to build new nuclear plants, which are today 10 to 20 years away, earliest starting point, and B, the sort of significant construction costs. So the cost of building these plants is much, much higher, and it's got a much higher levelized cost of energy than wind and solar. So maybe turning back to the JSE and why Greencoat is taking the decision really to list down here. I think the first piece is we found the market to be very favorable in terms of the scale of capital, the scale of understanding of the energy transition market that's here today, and it really has giving exposure to investors who understand energy and who understand the structures of investment companies. The second aspect is we feel it will support, there is support there for people who can basically enhance liquidity and diversify the shareholder register. We're entering the market today on the All-Tex, which sort of mirrors our existing listing structure in Europe and the UK. But it is very much our intention to step up to be a main board company on the list JSE main board, and we would hope to deliver that at some stage in 2025. And fundamentally, it gives the business access to another deep capital part of market where there's home to sophisticated investors. So maybe to summarize, we're really well positioned for growth. We've had disciplined capital allocation and continue to deliver significant capital back to shareholders through 24 and 25. The tailwinds of this sector are providing very, very strong opportunities as we see the AI and electrification driving increased demand and gives an opportunity for higher power prices. And then finally, we are a returns-led company. And the entry point today, for investors across the portfolio, which represents a 13% return on the share price and a 9% dividend, we think provides an interesting story for investors to think about and get their heads into. So look, I'll stop there, Vanessa, and I'll hand back to yourself and to the team.
Thank you. Thanks so much, Paul. We're now going to proceed to the Q&A. So if you haven't popped your questions in already, please do so into the Q&A box at the bottom of your screen. And I'm handing over to the finance ghost and Mark Tobin. Over to you guys.
Thanks, Vanessa. And Paul should go unlock the stock agus Africa Tess. I'll translate that for
Mark. Thank you very much.
I'll translate that for the non-Irish speakers on the call. Welcome to Unlock the Stock and welcome to South Africa. Paul, maybe we might start on one of the more bigger macro themes. I know since the Ukraine war, you mentioned gas there. Energy security has become a huge issue in Europe more broadly, and we've seen the former Baltic states of Lithuania, Estonia, Latvia completely disconnect now from the Russian power system and is fully integrated into the European power system, a process that was kind of happening before the war but has now completely happened. Just in terms of that driving policy at a European level, given you operate kind of around the continent, what are some of the regulatory environment things that the Commission is doing or Parliament is doing to, I guess, expand its capacity, but also in that the mix of its capacity? You talked about gas there, but obviously renewables is going to play a big part in providing that overall kind of security blanket from an energy perspective, given anything to do with Russia is kind of off the table for the Europeans at the minute.
Yeah, thanks, Mark. I think the market across Europe, the market for renewable energy is growing in every country across Europe, and it's growing and it's growing for slightly different reasons in different markets. Is the truth about it. So and that's one of the fascinating things of Europe. Each country has its own slightly different set of drivers as to why, whether it's the sort of the resource that they have, be it wind and solar. It might be in some cases where they're coming from in terms of they may be very early on into their decarbonisation journey, and they need to sort of pick that up. Or thirdly, it's kind of demand is sort of emerging rapidly into that market, and they need to sort of backfill the solution to that. But if you look at the big drivers of Europe the last 5 years, it's been Germany, France, Ireland, Spain. And pardon me, I'm in Dublin today. We don't often hear that noise, but it's those countries are the big drivers of that. And so we've had a lot of offshore wind in Germany. We've had a lot of offshore wind and onshore wind in France, and in Ireland and Spain we've had a lot of wind and solar coming into the mix. And really those were backed by governments saying we want to move our electricity grid from being towards 70 to 90% decarbonised by 2030, and that's really what's getting at almost every country today. They want to move quickly to decarbonise the electricity grid, and that's relatively those markets are what I would call mature markets. You have stable policy. Either the government are giving you long-term contracts to build these assets, or in addition to that, corporates are happy to give you the same type of contractual fix. So those markets have been around for the last 10 years and are continuing to grow. What's changed beyond that is really as solar technology became so low cost, you started to see solar making a lot of sense really in mainland Europe, and in particular countries in Eastern Europe. So countries like Poland, Romania, Greece, Hungary, all of those have rapidly moved to taking solar as a big mix of their decarbonisation strategy and bringing a lot of that to play. And then more and more recently, we've seen countries. We've seen the Baltic states really, as you say, become part of the overall European energy mix. And what that then is doing is it's driving investment into infrastructure assets, because there is no other alternative. Like if you were running off Russian gas today, you basically, your best way of creating energy security in Europe today is by building a lot of onshore wind, a lot of offshore wind, and maybe some solar. So each country is kind of just accelerating its infrastructure investment. I think the reason it's going so well in Europe is that by and large, the regulatory risks are deemed very low in each of these countries. People view there's a low risk of sort of policy change, and the price you can get paid, which is ultimately the key piece, the price people are prepared to pay for renewable energy gives you a sensible return. And so when we talk about buying infrastructure investments, you're talking double-digit type returns for investing into these assets. So that sort of environment is allowing a lot of capital to flow into the market and for people to decide it's a good long-term stable place to invest.
Yeah, thanks, Paul.
Hello, Paul. Welcome to Unlock the Stock. I don't think anyone was more excited than Mark to have you on here as a fellow Irishman. So it's nice to see and welcome. Some nice questions in the DMs already, actually. So people are clearly interested here, which is lovely. First question I want to ask you is a bit more high level, though, just understanding, in South Africa, when we hear about renewable energy projects, what that normally means is you've got a big mining company and they've gone and done a project somewhere and they need to go and get renewable energy for it because historically we couldn't trust Eskom. And that's literally our sort of understanding and frame of reference for renewable energy. It's quite different in Europe. So I think what I wanted to understand is, you talk about contracted cash flows, merchant cash flows effectively. Who is actually your end customer? Like, how does this work in practice in all these countries? Are you selling to governments? Are you selling to corporates? Are you selling to households? Just because in South Africa, we don't know this life. We really don't.
Yeah. So it's a great question. Good morning, Ghost, and thanks for having me on your show as well. The starting point in all of the mature markets that I sort of touched upon, if you take again France, Germany, Ireland, Netherlands, you're essentially selling to the government. So the mechanism might be different. You may end up having a PPA that sort of trades through a supply business, and that there are complexities in how that works. But from a simplicity perspective, the price is underpinned by the government, and what that therefore means is the revenue you're getting per megawatt hour that you generate tends to be a fixed price that it escalates with inflation every year, and therefore the government are underpinning that price, and basically they are most likely then transferring the risk from their side. If the price is lower than the market price or higher than the market price, they are taking the risk against that. So the typical type of contract for difference type of arrangement. And so what that means is you as an investor, or you also as the owner of these assets, we're not exposed, on those government contracts to sort of how do we trade the power, who's going to pay us, what are the mechanics of it. It's all very, very well established long-term arrangements. And we may use a utility to sort of act as an interface between us and the government, but that's just to sort of allow the power to flow, and it's an administrative role as opposed to being a sort of trading or a basis risk role. However, that was probably the story of of the last 10 years, and the market is changing today. So if you take some of the more recent deals we've done, where we've done a deal with Microsoft, we've done a deal with Keppel to sell them renewable power. In those sort of cases, that's becoming more and more the situation where these type of corporates will approach us, and they want to do two things. They want to decarbonize their enterprise, and in addition to that, they want to basically guarantee themselves fixed prices for the next 10 to 20 years. So that's their objective. And renewables is very unique in its ability to give that sort of solution to large industrial customers, because you can't get that sort of price certainty from fossil fuels today. In terms of who are therefore it's the same kind of approach, however, as a government contract. In the case of we may use a utility as a sort of interface to trade the power, but ultimately our price is backstopped by a large corporate, and that's becoming a growing piece to it. There is still the opportunity to trade power on the market, like you would in South Africa, like you would with fossil fuel. And that is something we do. So about 20% of our power today, we trade on the open market. We take the spot price, you know, we might hedge on day-to-day basis, but ultimately we still like the exposure to European power price markets, because most markets are set by fossil fuels. Gas prices can remain at an elevated level. So it does mean renewables can continue to capture sort of higher prices in the market day to day.
Paul, I'm going to get two questions in here, but one should be very quick, and then the other one probably will lead a bit more in depth. As part of this listing on the JSE, you're not raising capital as part of this. This is a pure secondary listing. So if people want to buy shares, as soon as you're listed on the exchange, they can just go through Easy Equities or whichever broker and they can buy. But there's no kind of secondary offering IPO style process happening as part of this.
No, not for now. You know, it's essentially buying a stock as you would from your own broker.
Yeah. Okay. Just to clarify that for people. So as soon as it's listed, we'll be able to buy shares on market. There's no applying for stock in a sense as you would in an IPO. The second question is a little bit more detailed, specifically around, you know, you mentioned the 9.4%, you know, equity lever discount rate. Maybe just break that down into, you know, what that kind of actually means for the layman in terms of, okay, we're looking at a greenfields project off the coast of Bilbao, northern Spain, great place for wind, and good place for soccer as well. But, you know, you're assessing that deal from, you know, the local government there or the Spanish government, you know, want to put something in place there. You're one of 3 or 4 bidders. You know, how does that 9.4% feed into, okay, what is the bid that we can put in here on this project that's out in the market for tender?
Yeah, it's a great question, Mark. So in our business, I guess, we own 40 assets today. And so, you know, when we think, how do we report back to the public markets? So we report on a quarterly basis back to the market. So, you know, we update and explain the valuation quarter on quarter. And, you know, it's essentially a DCF valuation of our business every quarter, a discounted cash flow valuation basis. So what does that mean? It means we take the cash flows that we can see against all of those 40 assets, and we essentially have a combined group gross cash flow line. That's essentially what you get when you consolidate in what we project from our contracted revenue base, and when you consolidate in what we have from our merchant cash flow base. And that gives us a view for the next 25, 30 years, what we project those cash flows to be. And we do that on a sort of gross basis to begin with first. And then we have leverage in the business. We project out the cost of interest that we have on that debt, and how we keep that debt at a sensible level. And then we run that cost of interest against it. And then when you get the net equity cash flows back for these assets, you get back a level of 9.4%. So that's the equity return that you would get today after you've repaid the debt for holding these assets over their full life period. So if we were to want to sell the portfolio today, an investor would have to be happy to take a 9.5% type return to kind of own these assets for their full life of the operations. That type of return is kind of what you see in Europe. So not every market is the same. So if it's a 20-year government-backed contract where there's no risk on the revenue at all, and it's a really straightforward site, you know, the lowest risk sites, I guess, you know, in some parts of Europe today, the returns for them might be 8.5% to 9%. That's the kind of equity return that investors will get paid. And if the risks are higher, if there's less contracted cash flows, or there's a different ability to put less leverage in the portfolio, the returns might be in the sort of 10% type range. So that tends to be the bookends of where we see returns for these assets. And our job, I guess, is to make sure we can get assets that are giving us above market returns. That's what we are constantly looking to see across the markets.
Yeah, thank you.
Paul, I have quite a layered question which might need a long-ish answer, but I think it's going to touch on a couple of pretty important points based on some of the questions I've gotten in my DMs and things that I wanted to ask you anyway. So obviously, because you're listing by introduction, there's a share price history already. And if you go and draw the charts, it's been under some pressure recently. Now, I would imagine that Greencoat would behave as somewhere between a government bond and a pure equity exposure, just because of the underlying cash flow nature of things, contracted cash flows, practically utility level type of business. So that's not unexpected given what offshore bonds have done, what rates have done. And it's important for anyone understanding in this, I think, to familiarize themselves with that sort of investment profile. I definitely wouldn't ignore that or think that this behaves like pure equity. I guess the question is around, also in the context of how you've changed your investment management fees. I see they now reference not just NAV, but market cap as well. So there's some recognition there, that stuff has traded down. I guess the question is, what can you do about this outside of just being, on the other side of market forces? I mean, maybe one of the ways to get past this is to talk to some of the growth opportunities you have in the fund, to keep finding assets. You've talked about how the European market's quite mature. What can you do to avoid just being profiled as a government bond, a set of cash flows in euros, and then lumped in with that? Sorry, as I said, it's a long question.
No, it's a great question. I think it's reflective of where the European market is today. You're right. Like, I think when interest rates in Europe were very low, and we obviously had a period from maybe 2017 to 2022 where they continued to decrease, and towards the end we're really at 0%. What you essentially had in the market, I think at that stage, was a lot of investors seeking yield and seeking income, and we definitely had that phase of yield being the sought after yield being kind of in the market at that point in time. I guess since we saw the UK and the Liz Truss moment in 2022, where interest rates really changed the other way rapidly, and then Europe followed suit, the sector has been kind of caught in that big macro trend. And what I mean by that is that there's been just much less capital in the sector to sort of support the energy transition sector. I think my sense is that you have to separate out how the business is doing and then the capital markets piece of that. And where you look at what the business is doing, well, it's continuing to perform really, really strongly in terms of dividends, in terms of cash generated, and by and large in terms of NAV growth that we've seen since over the last 3 years. It's in addition to that, it's been about showing investors the conviction of the story. So demonstrating selling assets above NAV, that we can recycle capital and we have flexibility in doing that. Demonstrating that we continue to refinance the business at a very low cost. So we did that again at a 150 basis points margin above Euribor. Showing capital discipline, I think, in a time when capital is perhaps a little scarce. So I think we've gone through that sort of cycle of sort of showing the investors the sort of robust nature of the business and where that sits today. But you are right. There is a huge growth story to come from this, and I think we're probably at that point in the cycle now where, from our side, we can see lots of areas where growth opportunities will emerge in the next 12 to 18 months. Areas such as digital data centers, where we have the opportunity to co-develop data center sites. I think in markets which quite well. We have the opportunity to put more technology on some of our existing sites, so adding storage to solar sites, adding solar to some of our wind sites, looking at potentially ways that we can use some of the pipeline projects that we have in our business, so secure projects we have, and sort of finding ways where we can bring capital into those and deliver better returns. And as a business, we're 8 years into our life, and we've gone through 2 big macro trends. I think in that period we've gone through a period of very, very low inflation and low interest rates, and we now come through a period of really, really high inflation, high interest rates. And in addition to that, we've probably had the highs and the lows of energy transition in that period, where sort of up to 2022 again there was a kind of a huge appetite for energy transition, and perhaps with the policy change in Trump we've seen less of that over the last few months. So the sector, I think, is still finding its kind of long-term positioning and sort of where that looks like. But our business, we feel, is in a very strong position to play through the next few years, and the business model we have, which is underpinned by dividends, that piece remains as true as it did 5-6 years ago, even recognizing that today it is there's less appetite, there's less capital in the market than was the case 2-3 years ago.
Paul, I'll do my similar act from the last one, a quick one, and then maybe a more longer one. There's a couple of questions here around Greencoat getting involved in renewable projects in in South Africa, or maybe let's broaden that out to maybe Southern Africa in general? Is that a possibility, or are you totally focused on the European opportunities in front of you?
Well, my phone hasn't stopped ringing. That's or my LinkedIn hasn't stopped to whichever that is. But it's been really interesting. You know, the amount of people who've reached out to me, you know, who are in the broader energy sector in South Africa, who are interested to kind of explore opportunities, who are interested to sort of talk about what's happening in the market here and see and have that conversation. So I think, you know, as a manager, as Schroders Greencoat, like, you know, we already have a presence, Schroders, in South Africa. You know, we will now have a listed business on the ground here in South Africa in terms of being able to invest into Europe. So I think it gives us a proper presence it gives us a proper presence in the local market and an ability to start to sort of, you know, to really talk and discuss where those opportunities can fit. I don't think in Greencoat Renewables we will start to invest certainly in South Africa in the short term, because it's not in our strategy and it's not in our policy. So it's probably not the right business to sort of set out to do that. But like what you're seeing, I guess, is this is the first time you're having a pure play energy company, you know, European energy company come onto the market, sort of specifically designed for investors that are looking for perhaps the lower end of the risk spectrum, who are more looking for dividends and who are looking for that area. And I guess we will continue to see just that type of opportunity emerge, you know, perhaps in a slightly different vehicle over time to come for the South African market as well.
Yeah, I think you know, we see here the breakup of Eskom from being, you know, a fully integrated model to a more disintermediated company with the distribution, the transmission, and the energy company. And while we have seen renewable energy products down here, you know, you're just basically selling back to Eskom, and it's been, you know, wind down here in the Western Cape where I am, and you know, big solar projects up in the Northern Cape. But if I can just talk about pricing for a second, you mentioned, you know, about 20% of your energy production, you know, trades within the open market. And we saw, I think it was the slide about the dividend, you know, there was, with the huge increase in power prices we saw post the start of the war in the Ukraine, you know, obviously that you had a major effect on the revenue line for all, let's say, generators of energy. But in terms of if somebody's trying to understand, you know, how much of your revenue is like completely fixed with some kind of agreed inflation increase, and how much of it is variable in terms of you're either trading on the spot market or the contract in place, whether it's government or with a corporate, has some reference to the spot price and maybe a few other bells and whistles around there. I'm just trying to get a sense of how much is completely locked in and how much is still variable.
Yeah, I think when we were having that conversation, we touched upon this at the time. We were saying that it was, pardon me, we talked about having 71% of our revenues contracted out to the end of 2029. And what I mean by contracted, that's fully contracted, no merchant exposure, you know, basically locked in and sort of getting inflation-linked revenues year on year. So that is the bread and butter of the business today. And what we see, just again to kind of help people to better understand it, you know, what you have in Europe, however, is a very active market that when you end your initial contract, that you can recontract the power again for another 10 to 20 years. So just because the contract ends in 2029, you know, ultimately what you have today with renewable power is you're selling a product that competes with European gas prices. That's the alternative. So when we have our 22%, you know, today, this year, I think that's going to be sold on the open market. You know, really, you know, we're feeding into a system in Spain and a system in Germany where basically, you know, the price that sets the marginal price of electricity is gas. And, you know, that's why European power prices are much higher than any other country, because the price of gas is so high in Europe. And, you know, we also have quite a high carbon tax on our power market. So therefore, the pricing in Europe today, in Ireland, Germany, is roughly speaking 100 to 120 euros a megawatt hour. That's the kind of spot price that you see for power. It goes down in the summer when we have more solar on the system. It generally is a bit higher in the winter. So I think it trended, you know, it'll trend down to 80 to 90 euros over the summer months, and then it'll go higher again in the winter. So you are well paid today to own renewable assets and to have that on as sort of just capturing what the day-to-day price is. There are days when the price is lower. You know, if it's a very windy, very sunny day, you know, there'll be too much renewables on the system and the price can be lower. And then there can be spikes if there's a sort of a, you know, if it's a particularly cold period. We basically, when you look back on the last 5-7 years of European power prices, you're correct. They were structurally low coming through COVID. Power prices then started to grow substantially as demand in Europe sort of started to take back up after COVID. And then when Ukraine hit, we had an 18-month kind of crisis period where gas prices spiked really, really highly. And sort of what we've seen happen really over the last 2 to 3 years is they've trended back kind of where they were 18 months after COVID. So structurally operating about the €100, 80 to €100 a megawatt hour range. What that means for business assets like ours is we have a choice to make. Do we sell our power just in the spot market and take that volatility, or do we offer to do a corporate PPA over a long-term period? And the price for the long-term period tends to be, you know, at a discount to the prevailing price. So, you know, the most recent PPAs that we've signed in Ireland were between 80 and 90 euros. That's the kind of price that we've signed them at for 10 years, and that inflates. And again, that was a similar price that we achieved in Germany for a 7-year contract that we signed.
Okay, thank you.
Paul, this might actually be a question for your advisor, but I'm going to ask it anyway, just in case you can answer it or give a view. So when you're listing by introduction on the JSE, what are the chances of there being liquidity in the shares? I mean, you're not raising fresh capital, right? You're not coming to South African investors and saying, hey, put money in this thing, please. You're listing by introduction, which means at some point there's hopefully going to be some liquidity on the South African register. I don't know if that's something you can actually talk to. It's obviously just a question that has come through, which shows that people are interested. So, that's a good thing.
I think the first thing is we disclosed that we had immediately created a small amount of liquidity local on the market by doing, and we were obviously required to do that by the JSE to have a certain level of local capital in there. I think to give Valio the credit, they've worked really, really hard with the brokers that they're working with in the local market to create a two-way flow of shares, I should say. So we're really confident that the sort of partnerships between the banks that sort of are the main brokers of our stock in Ireland and the local banks that Valio are working with, those shares can flow rapidly. That there's no hold up in that, and that it's a sort of intraday market. So we don't expect there to be any complexities, and we've done a lot of work on this to sort of block a local shareholder in South Africa to be able to get the stock directly that's being sold on the European markets at the same point in time. And we've a couple of brokers that Valio are working with, one at the sort of really upper end scale of things where if it's a sort of big block trade, but at the smaller end we see the same as well. So I think there's I think we're happy that the flow is going to be very, very simple and transparent between the European line and the South African line.
Yeah, brilliant. Thanks.
Paul, probably people don't follow the UK investment trust market maybe as closely as I do. I've got a kind of a history in investment trusts before I started this business, but there's been a lot of, what's the word? I don't want to say angst. A lot of dynamism happening there by a US hedge fund, coming in and, focusing on investment trusts, which Greencoat kind of falls under that kind of broad sector within the UK market, looking at things that are at big discounts and, trying to change boards and trying to, get asset realizations happening and all of that. But we've also seen the big Canadian pension funds and, Brookfield, buying up stuff. And I saw, Victory Hill Capital are winding down their vehicle now over the next couple of years. They announced, I think, earlier in the week. Is there a play for Greencoat there for some of these trusts to have, I guess, taken the nuclear option and decided to wind down and are looking to offload assets for Greencoat to pick up some of that, or maybe mergers with some of the smaller ones who haven't got the scale of Greencoat, but don't want to particularly sell their assets, but would be more amenable to it becoming part of a kind of a broader portfolio for their shareholders who are not keen on delisting and kind of see with, I guess, with all these renewable and infrastructure assets, like it's investors who are in there for the long term by the sheer nature of the underlying assets.
Yeah, it's a great look. I think the investment trust sector is it's actually doing what it's supposed to do in a period of sort of market challenge a bit. Like, so, if you think of some of the benefits investor trust sector give you is, you fully independent boards, who basically are there on behalf of shareholders who can, the manager, reports into the board, but that's the case. The second is you have an investment policy that means if you trade at a discount for a period of time, you have to seek the right to continue as a company, and therefore shareholders have a right to kind of sort of say what this, feed into that strategy and make that happen. And thirdly is, the valuation is transparent for everybody to see. So therefore people can decide discount to NAV versus not discount to NAV, that opportunity is set. So I think that all of that governance has actually probably worked in favor of investors, when you start to see dislocation between share price and NAV. We had our AGM in recent weeks. I think we had 83% of investors essentially said, look, we want this business to continue. And that was, so there's this, I think the sector is telling you, investors are telling you they want the renewable infrastructure sector and the investment trust sector to remain as a strong sector. But what they're also saying is they want it to be bigger, stronger, more liquid players. And one of the challenges I think we had, was perhaps there was a lot of listings of smaller subscale vehicles that essentially also came very late in the cycle and bought assets that were probably at prices where returns were at the lower end. So you're seeing some of that washing out now. I think I would say takeouts are good. Like, you've seen some strong takeouts. We've seen Brookfield take somebody out. You've seen Drax take from people out. You're seeing vehicles kind of coming out, so that's good. Investors get their money back, and they're tending to get their money back at NAV, so that's giving them the kind of return they wanted. You're seeing some consolidation happening, players to players, particularly in the real estate and the social housing and social infrastructure, sort of mergers of vehicles coming together to create better liquid vehicles. And then finally, for boards that aren't responding or listening to what shareholders want, you're seeing activism, where activism is there and is good for investors as well, because it's sort of driving change where people perhaps are a bit slow to do that. And so I think there's a healthy degree of kind of action, focused to action on boards and on companies to make sure they're doing right by shareholders at the moment. We continue to look at opportunities. Is there an opportunity to consolidate or to do something? I guess our question is, it has to make sense for every company. We've built a really good portfolio. We've built a really stable set of cash flows, and our business model is really clean. And I think anything we would ever do needs to make sense for our shareholders, as opposed to something that happens in the sector as a whole. And perhaps also some of the opportunities that are emerging now are less about consolidating older assets, potentially more about the sort of new areas that are emerging in energy transition, where perhaps there's higher returns to be achieved.
Do you want to squeeze one more in?
Yeah, literally just one more, and it's kind of like a closing comment, I guess. I mean, there's obviously been comments around, we're kind of in Trump's world now. It's a very interesting place. There's lots of geopolitics. There's lots of question marks around reindustrialization of Europe. You've got some big exposure to Germany, which is an economy that's struggling with the automotive sector where it is at the moment. You've got data centers. I guess I just wanted to end off by asking you for the sort of 1 minute elevator pitch that, from a geopolitical standpoint, your positioning in Europe and everything else, how should investors think about that?
Thank you. I guess to finish off, we've built a business that is of scale, that's pure play, and that has a very transparent and clear investment story. The opportunity for the business and the tailwinds, I guess, are the fact that there is going to be substantial need for capital in European energy transition. And then the second element, I think, is there's substantial appetite for green energy in Europe. It's the biggest, the commodity demand for it is so high. So I think both those themes give us a great chance, not just to continue to deliver stable returns from our existing assets, but we hope in time to be able to continue to grow and remain a leading player in this market.
Thank you, Paul. Thanks so much for giving us the time today, and thank you for everyone who joined us on the call today. And really, Paul, a great thank you to you. for spending this time to help the retail investors in South Africa to understand and to engage with you. And we wish you well for the listing later on in June. We hope that everyone on the call has enjoyed it. And if you want to listen to it again, it will be available on our YouTube channel soon. We encourage you also to subscribe to this channel, please. Our next session takes place on Thursday, the 12th of June, and that will be featuring a regular to unlock the stock, and that is Teresa. That is then all from my side. Goodbye, everyone.
Thank you very much.